when you encounter slippage, you may think that you're losing, say, like 2% on a trade or 1%. Say you want to risk 1%, and you end up losing 4, 5, 6% due to slippage, right? So the initial thought is, okay, no trades before NFP, no trades before restricted news events. So this is the likes of NFP, CPI, or FOMC. They are like the three main ones, right? The three main ones. So what we're going to do, we're going to wait for NFP to be released. My expectation, which isn't always right, as we know, is we see the liquidity sweep above Asia high. NFP creates this manipulation, and then we continue lower, right? So remember, we're sell bias. We need to see fresh liquidity taken out. Where is that liquidity resting? Where is that buy side liquidity resting? Asia high. Okay, so the expectation is the news will create the liquidity sweep before we continue lower. That is what I need to see. But let's see. What I'm going to do is call JP Morgan, let them know that this is the plan for today, and they should follow through as always, right? So expectation is we take out Asia high, liquidate above here. Then once we see that price action, right, this is going to induce a lot of traders long into this market. They're going to see this as like a double top in the market. You know, they're going to have stop losses above here. And so they're going to be induced long into this market. Breakout traders, momentum traders, they're going to see this as a breakout. As we know, this is what the institutions need, right? They need that equal and opposite liquidity in order to fill their institutional sell orders. So that sort of comes back to slippage again, which is in order for bigger players and institutions to prevent slippage, they need to have somebody on the other side of the trade. How can they get someone on the other side of the trade? Inducement via retail concepts, right? So far we've had the release of NFP. We've started to see what I thought was going to happen, which was liquidity sweep above here, right? So a lot can happen. We still need to wait for confirmation. We need to wait for sellers to take control of this market. Then maybe we have a shorting opportunity. But at the moment, we have, you can classify this as a liquidity sweep, as a unresolved liquidity sweep, meaning, this could continue higher from here. We don't know, right? And that's why we need to sort of wait and see. And, the framework of a professional trader is always using logic, right? If this, then that. That is how all traders on a professional level operate. If this happens, i.e. liquidity sweep, then I will look for a confirmation. And you keep going down your plan, right? You have your plan in front of you and you're like, okay, I need these 5 or 6 things to happen. Okay, if this happens, then I need to see this happen. And if that happens, then I need to see the next thing to happen. And you keep going down until the final thing is pull the trigger, execute, right? But you don't just get to the execution, right? You have to go down that methodical, systematic process in order to get there. The problem is most people don't have that process. They're just sort of pissing in the wind. Let's be honest, right? But so far, so good in terms of what we want to see on an intraday basis. Oh, so you were connected in Discord and Google Meetings. Damn, you're greedy, man. Save some space for others. Come on. I'm just checking, guys. So as we progress, there's going to be time for Q&A, right? So I encourage you, if you have any questions or anything that's on your mind at the moment, pop it in the Discord, in the chat, or pop it in the Google meeting. I will get round to them, in a moment, but just queue up the questions, right? Because we're going to be firing away shortly, right? Firing away with the Q&A. If I sound a bit funny, I'm a little bit ill at the moment. I've got the flu. But as you guys know, we still got to make this happen. We still got to make this happen, right? No matter whether you're ill, you have the flu or whatever, you still get it done. No matter how you're feeling, right? But yeah, God, when the alarm went off this morning and I knew that I had, 40 minutes on the Stairmaster to do, I was like, shit, how the hell am I going to get to the gym this morning? But you get it done anyway, right? That's what we do here. Okay. So as we know, right, sell bias. Let me just spell this out so everybody's on the same page, right? Sell bias. We need to see inducement. We've just seen inducement. Because think about how many people are going to be getting long here, right? They're going to see this is a breakout high. Momentum traders, they're going to have buy stops above here, which provides buy-side liquidity. They are going to see this as a breakout. So they're going to get long, stop loss, maybe somewhere in this move or maybe below here, providing buy-side liquidity. It's this buy-side liquidity that institutions can actually use to match up their sell orders, right? So if an institution and a bigger player wants to short here, they can do this here without any slippage. Because they have that other person, not just person, they have millions of people on the wrong side, getting long and providing buy side that they can use to fill their orders effectively without affecting market price, without encountering any slippage. The volume is here for institutions to fill. And so we've seen that, right? We've seen the initial reaction. That's what this is, right? You can see we've sort of pinned into this level. We've started to reject. That's the first sign. Like before you even get a confirmation, it's like, are you actually reacting off that level? And this is showing you literally in real time the orders being filled. And that's really what this is, right? When you actually think about what a wick rejection is, right? It's in the last 15 minutes, buyers try to take control, i.e. providing buy-side liquidity. Sellers, i.e. bigger players who are informed, they can position. And so they're starting to take control. So this is like the first signature, the first sort of evidence, if you like, of bearish pressure. Now, does this mean that sellers are here and like this has to roll over here? Not at all. Just because we've seen a small, to be honest, it's not a small reaction. Like that's quite a large wick rejection. Let's be honest. But that in itself is not enough evidence to give you the belief that this is going to trade lower, right? And that's why we need to wait for a confirmation. So we have 6 minutes left of this candle to close. There's a couple of real scenarios. Number one, really there's a few. So number one is we close bullish, kind of like how we are. And then we're going to be waiting for the next candle to confirm. right? And then if that is the case, you have an invalidation above liquidation. You're anticipating the next candle flips and closes bearish, and you've got a trade lower. So that's like scenario 1. Scenario 2 is if we do flip right now, which we're actually starting to do, and we do close bearish, right? You've got an entry, right? So just because price was up here before, you have to be mindful all of the time, like, what if this flips? What if sellers just fully take control here? We flip, close bearish. What would that mean to you? Well, for me, it would mean I'm going to be taking a trade for sure, right? Because if this closes bearish, you're going to be entering on the break of the low, invalidation above liquidation, target of 1 to 2. You've got external range liquidity at London low, right? And you have sort of the low of the day here, right here. So it's important to be mindful of how, not just like the confirmations and like what you want to see, but also how are the candles forming. For example, if you want to sell the market and you see price in the first like 3 minutes aggressively push to the upside, well, you know that in itself could be grabbing liquidity, making the top wick of the candle before we roll over. So, yes, I talk about confirmations and all of that, which is very vital and important, but also understanding where you are in the candle, meaning, if we've pushed higher in the first 5 minutes, well, that, and like the candle's not got a bottom wick or a very small bottom wick, it's likely you're going to create one. And so you're mindful, like, okay, we push in the first 5. Well, we have another full 10 minutes where price could reverse and start pushing lower. And so you can start to build the kind of story as it's happening in real time, right? How about gold? We can take a look, but this is where you have to be accountable, right? So now, guys, we're looking at gold on the 15-minute time frame. What do we have? 50, 200, 100. What does that indicate to you? And you should be screaming at your chart, screaming at the screen, right? What does this indicate to you? Not only what does it indicate to you, are you accountable enough to stick to what you think is the bias, right? And for anybody that's new here, this is a no bias market, meaning you're not looking for any positions. And then it's up to you to be accountable to not place any trades here. Do you have that conviction? Do you have that belief? Right? I recommend like physical ways to do this. So you can, some people use a whiteboard. Some people write it on the notes and they stick it in front of them. I'm not a huge fan of like digital things because I think, there's more friction involved to go and access that digital thing. So, have it in front of you. I have my plan in front of me right here, laminated. Okay? Accountability. That's what it does. It keeps you accountable. Because you have it in front of you. If you have your plan in front of you and you go against it, yes, it's possible, but it's way less likely. Whereas maybe you don't have a plan or you have a digital plan, which you have to go and find and you're not always reminded of it. More friction, more likely to deviate. Right. So gold, no bias, no problem. I'm not going to waste any more time looking at it. What's the point? Okay. So now all we're waiting for is, can we flip, or can we at least confirm and close bearish, right? So we're looking for a 15-minute bearish confirm. Okay. So this needs to be on the closure. We're not waiting, for just like a bearish candle, right? We need a candle close, which is bullish. That's going to indicate to you that, all right, we've had that injection of bearish pressure. Sellers are actually stepping into the market. That is your sign that sellers are taking control after seeing the inducement, right? After you've seen a liquidity sweep, that is your sign. But be mindful, because if we do flip here, like I'm ready to pull the trigger, because if we do flip and close bearish, I'm short here on the break of this low. Okay, so we haven't quite broke the low. All right. So now what we're waiting for, we've got the confirm, right? We need this candle to flip and break this confirmation low. If we do that, short, invalidation above liquidity sweep. It's as simple as that. Right? So you need to monitor this level 6807. Looking for this candle to flip. If so, short. So this is the waiting game. So just to make this very clear, I will be, you can either set a sell stop below this low, or you can manually execute as we break the confirmation low. Your invalidation is just above the liquidity sweep. So to make this very clear, this is how the trade looks. Okay. So you're expecting a daily cycle, meaning like a full daily candle cycle, a continuation for the rest of the day, taking out this external range liquidity, right? We've saw the confirmation, but we need to see the conviction. So how do we know if sellers are actually present? Well, that will be indicated by, the initial low of the confirm, followed by another lower low. How do we get that other lower low? Well, the only way is if this current candle flips and breaks the low. Then you've got two bearish candles, two lower lows after confirmation. That's a bearish signature in price. Okay. So now we wait, right? We're patient. We're not just going to be diving in, looking at the market here. Because at the moment, price is pulling back, right? So if you're entering as price is pushing higher, you don't know where this is going to stop, because you're entering as buying pressure is stepping in, compared to if you're entering as selling pressure steps in, i.e. we break this low. That's a much higher probability trade, because you're entering with momentum as opposed to going counter momentum. Like if you enter here, yes, you're getting a better risk to reward, sure. But you're going counter 15-minute momentum, because the You're entering as buyers are showing strength here. I want to be entering when sellers are showing strength. That is an A+ trade, right? When sellers are there and they're showing strength. And you can see that in real time, right? So now we wait. We wait, we do nothing, and we be very patient. Very, very patient. Is it possible to trade this on a cell phone? This is from Metallica Kyoto. 100%. When I used to work a corporate job, yes, I had my charts in front of me, but there was a lot of times when I was in meetings and I was just executing on my phone. Analyzing, executing, for sure. And that's the beauty, right? When you're trading a mechanical system on the 15-minute time frame, you don't need a lot of fancy, you see people on these like huge monitors. Like if you have a small phone, you can trade it. Right? Trading view on your phone, fine. Turn it on its side if you need to. Zoom in. Absolutely fine. Okay, we got a great question here from Banasek. Okay, so he's saying that, he's trading with Pepperstone and his Asia high is maybe slightly different to mine. That is okay. What I encourage you to do is you need one liquidity feed, meaning one place where you do your analysis. So for me, it's capital.com. All of my analysis and my decisions are based off this liquidity feed. Then once I've made my decision, like for example, right now, we want to be short, right? Once you make that decision, you then go over to your prop firm, broker, or whatever, which their liquidity feed will be slightly different. Or maybe you're trading futures, which, with that, the liquidity feed is always the same, right? What I'm trying to say is you make your decisions and analysis based on one liquidity feed, i.e. capital.com or whatever you want. Then once you've made the decision, like I want to get short here, you then just go over to your broker, you execute, right? If there's a huge discrepancy, what I recommend to do is manually execute as we break the low on capital.com. So don't look at your broker to make a decision. You should only be looking at one place to make a decision. If there's a huge discrepancy, maybe because the broker's not reliable, or, this is often the case with a lot of prop firms that are sort of very off market, right? Okay, we're tagged short here. I'm tagged short here. I don't know why I'm saying we, because I know you guys do whatever you do, but I'm short right here. Okay, perfect. So I'm short right here. Break of this low. Sellers are showing momentum stepping into the market. Okay. We've entered as momentum steps into the market. We've seen the liquidity raid. We've seen the confirmation. We've entered on the break of the low via a momentum entry model, right? Via a retracement candle. That's what this is, right? So there's many different entry models that you can use. Some of them are subjective. Some of them are mechanical, right? But the one that I like is a retracement candle, meaning a bearish confirm indicating sellers are taking control here. you can use like a lower time frame market structure shift. Like if we drop down, I know for a fact, we go down, there we go, right? If we go down to the 1 minute, what do we have? Well, high, higher low, higher high. Right? If we just take market structure logically here on the 1 minute, right? We have a low, we have a high, higher low, higher high. What have we done? Broke market structure to the downside on the 1 minute time frame, indicating a shift in trend. But that's why I like the 15-minute time frame, because I already know that. And that's where a lot of ICT goes out the window for me, because you can drop down to the 1 minute and get emotional and get stressed and, look at these intraday entry models, these sort of lower time frame entry models, which take up a lot of chart time, a lot of mental energy, a lot more sort of management. Or you can go, I'm going to be chilled as a trader, drop to the 15-minute. That tells me everything that I need to know anyway. And I'm going to be a lot more calm. Ultimately, the decision is yours. Whether you go down to the 1 minute, look for a change of character, right? Meaning bullish price action going up above a level of interest, Asia high, session high, etc. Then you're on the 1 minute looking for that change of character. Then you could look at shorting that to the downside. But my point here is that you don't need to do that. And what I found, from my 8 years of experience is the lower time frame I went, the more impulsive I was, the more likely I was to revenge trade, the more likely I was to hesitate, doubt, or, that starts creeping in. And so that's why I like 15-minute entry models, because 1, it's mechanical, 2, it takes the guesswork out of your trading, and 3, you're calm. To put number 4 in there, you now have so much less chart time, meaning you can do this easily with a full-time job, education, or even just a busy lifestyle. Because I see people dropping down to the 30-second time frame, for real. 30 seconds. Not 30-minute, 30-second. And, some people can do that, but most people cannot. So that does not make sense, right? What you're going to attract with that is a lot of degenerate people. That's not what I want in my community, right? And, we're all degenerate sometimes, right? But the goal here is to give you mechanical frameworks that are defined, that take the guesswork out of your trading, and that actually give you the freedom. Because what's the point in trading if you're chained to the chart all day? Even if you do this full time. When you pretty much get the same outcome of zooming out, looking on the 15-minute time frame, this already tells you what you already know, which is the lower time frame shifting, right? As I've just showed you before. So why do you need to stress? Like, one person gets gray hair very fast, the other's pretty chill. Which lifestyle do you want? Because I had 5 years of pulling my hair out, receding my hairline on the lower time frame. And I'm sick of it, is the honest truth, right? Like, do you want gray hair early? Or do you want a chilled life where you can spend time with your friends, family, still get amazing results, and you're very calm? Right? Decision's yours at the end of the day. But yeah, that's often a very common outcome of trading mechanical systems on the higher time frame, When I say higher time frame, I'm referring to 15-minute, which sounds crazy, right? But compared to a lot of people on the 1 minute, 30 second, right? 15 minutes, like pretty bloody high. So yeah, now we wait, right? This is a case where, okay, we are tagged in this trade. We know what we're going to be losing. Like if this trade hits your stop loss, you know your risk. You know exactly how much you're going to lose. Well, you should do, right? And then that's the hard work done. You allow it to play out. You accept that you now have a 50% chance of this trade playing out. You have a 50% probability of this trade hitting a 2R. I mean, at the moment, the way these live streams are going, we've had like around like an 80% win rate on the live streams, which is like insane. But everything aside, based on short-term results, this is the reality. So when people get overly confident, sometimes you need that reality check just to like bring you back down, to be like, you know, yes, the win rate's been like 80 to 90% on these streams, which is insane. But this is the reality right here. So it's important to keep yourself grounded, not to get ahead of yourself. When it's going good, you know, be grateful. But be grounded and understand these times don't always last forever. And that's not even being negative, it's just being realistic. And I think that's why we're growing so quickly. Because a lot of people are not being real, and maybe they're sugarcoating or, you know, smokes and mirrors, like making things sound better than what they are and all of that. And, you know, recently we just hit 4,000 members in the community, which is bloody insane, right? 4,000 people have clicked on the Discord, entered into the Discord, and consumed some of the content. Mind-blowing. Like, if you think about it, if you put everybody in like one room, you know, and like you're speaking to everybody, like that is insanity. That's a lot of people. But yeah. So the hard work is done here. Now we wait. Now we wait, right? We accept this. The market owes us nothing, right? We have a bias. We've seen a liquidation. We've seen a confirmation. We've entered with momentum. We have a clear invalidation, a clear target based on data. Based on data, not based on how we're feeling or what you think may happen, or based on an emotional home run, but based on hundreds and hundreds and hundreds of trades. That is the difference, right? And so, yeah, the data tells us that the optimal risk to reward is 2R. So that's what I'm going to target. So far, right, we had that inducement. What I believe is this is what provided the buy side liquidity for institutions to position to prevent slippage, to get their sell orders into the market, right? Stop out early buyers. Confirmation. And I believe that this market should trade lower based on all of them assumptions. You know, we're not just making this assumption based on one candle closure. Like I see people building a system based on like literally one candle. And cool, that may work, right? But it's the story that you tell yourself. Like when you piece it all together and you're like, okay, directional bias, inducement, liquidity sweep, confirmation, momentum stepping into the market during a high volume session, New York kill zone. You expect volume to come into the market. Does that mean it has to go lower? No, of course not. But you expect to know the outcome today, right? Whether this volume means lower or higher, it doesn't matter, but you expect volatility. That is the main thing. And that is one of the only ways that you can build belief and conviction in a system. It's from having that systematic rules, the systematic rules, backed up by years and years of data. Whether that's a track record, whether that's your own back testing, whether that's from forward testing, right? There's many ways to build conviction. A lot of it cannot be done by myself. And, you know, I like to think that I at least sound like I have conviction in my own system. So that in itself maybe breeds some conviction to yourself, belief in conviction, right? Breed sort of confidence in yourself. Because if somebody is passionate about something and you can tell in their voice that they wholeheartedly believe in something, well, you're going to be more likely to have that conviction as well. But I still think that the data, you know, whether you look at my own data, my own track record, my own back testing, or whether you do it yourself, or maybe a combination, very important to build that belief. Because what happens is you lose 3 trades in a row, right? You lose 3 trades in a row. What do? You then doubt yourself. You doubt your system. You hesitate. Then what do? You don't take a trade. You miss a winner. Oh shit, I missed a winner. Then, because you've missed a winner, you're like, oh, I'm just going to revenge trade. I'm just going to throw myself into the market. And you take a loss. And that cycle sort of repeats, right? And from my 8 years of experience, that seems to be the most common reason why traders are failing. It's a multitude of losses, right? Everybody's happy when you're winning, right? That's given, right? It could even be 2 losses. It could even be 1 loss. And I see it sometimes. You know, 1 loss, the doubt sets in, the hesitation sets in. And so if you're not grounded with a system or a process or a rules-based plan, you derail yourself, meaning you doubt, you hesitate, you overthink, you overanalyze, you strategy hop, right? And that's the horrible cycle. But it all comes from the systematic process to begin with. So you need to know, like, what is your plan for like every scenario? That's the only way, because if you don't define everything, well, there's going to become a time when, you know, doubt sets in. And this could be in the form of filtering A+ trades. This could be in the form of position sizing. You know, maybe you go in a drawdown and you start over risking, or maybe you start reducing risk because you're scared, right? That's often a common thing I see. Somebody goes into like a 6% drawdown. Oh, and then they half their risk. What's the point in that? All you're doing is just stretching out your time horizon and making it longer to get funded, right? Something I talk about all of the time is opportunity cost. Meaning if you do something like that, like you reduce your risk, right? Well, all you're doing is making your time horizon longer to get funded or longer to become profitable. meaning that you could be getting funded faster if you just stick to normal risk. You could be taking payouts along the way, right? Or you could reduce risk. Maybe that then takes like 8 or 9 months to claw out of it. For me, like, I'd rather just like know the outcome of the funded account. You know, maybe you either claw yourself out faster, maybe you blow the account, but at least you are giving yourself that opportunity cost, meaning you're going to get funded faster, meaning you can take consistent payouts along the way. And by the time this person has reduced risk, well, 9 months down, you've just took 5-6 payouts ahead of them. You know, maybe you've took 15, 20K out of the market. And this person's still trying to like, draw, claw it back. Just accept it, man. Just accept it, accept the risk. But I understand, everybody has different risk appetites. You're all in different situations. You're all in different financial situations. So what is meaningful to you is not meaningful to somebody else. And so that's why I don't really give like a sort of blanket approach to this. It needs to be very tailored to yourself. All right, so I'm just going to call JP Morgan. One sec, guys. I'm going to tell them to dump this right now. I told them to pump it before, so they've done that. That's cool. I'm going to call them, tell them to dump it. I know a couple of the banks as well that would do this, so I'll do that, and then we should start trading lower. So I'm just going to do that right now. Could I upload yesterday's stream? Yes, I can. So the exclusive stream from yesterday, if you check the streams in the Discord after this, that will go live. Do I consider spread? Absolutely. I would say less so when you have like a large stop loss. So like, for example, like a trade like this, at the end of the day, we need to be consistent though. But one thing I will say is like when you have a very large stop loss like this, the usefulness of spread is not so much because let's be honest, if price does retrace and get like, say like here, is it really going to turn around here? Like, do you actually think this is going to turn around here? And so this is like an instance where, yeah, you can account for spread above the high, sure. A little bit of spread. But it's like if you get price here, like 99% of the time, you're just going to be tagged out. So it's less important in a scenario like this, but it still is important to be consistent. What I like to do is, so US 500, I like to use 0.5 spread above the high. 0.5 US 500. Gold, I like to use 0.3. But you need to check your own broker because everybody's spread's different. Have a look, over the day. What is the average spread? Take the low and the high of the range. Account for the high end, right? Let's say your high end is like 0.7 for US 500. Take that, make it 0.8, account for that every trade. Factor that into your back testing as well. So this is another thing. Like when you look at all of my back testing data and my track record and every single trade that I've took, every trade accounts for spread above the high, even in the back testing. So you need to be accountable for that as well. If you're going to do it in real life, you want to bet that you're doing it in your back testing, right? It's way more important. Like if you have a tiny candle, like a small confirmation, to account for spread because you could get that small fluctuation and then you drop lower, right? And there was an example of this the other day, right? Which was this stream. So this was like a, God, there's a lot of shit on the screen here. Let me just get rid of some of this. So this was like an exclusive stream that I did the other day with all the students, where we took this trade. And the point that I'm trying to make is like, look here how the stop loss is quite small. So this is an example of where you need to account for spread, because if you do get something like this where we're very close to stopping you out, you don't want to be just tagged out and then it rolls over like this. So this is like an example of where spread, accounting for spread, is really important. Really, really important. Yeah, this was a beautiful trade. This was sensational. We've been on a crazy streak with US 500 recently. I want to say like the last 10 trades, we've took around 9 winners on US 500. So we've had around like an 85 to 90% win rate over the last couple months on US 500. It's been insane. And, you know, people say don't trade in December, don't trade in November, you know, it quietens down and all of this. Nonsense, right? Often a very common misconception. It's like, if the data supports it, why not trade it? Unless you have a reason to not trade it, then cool. But if you don't have a reason, you trade it without hesitation. Yeah, this is like an example where you would account for spread. Make sure. Something that I talk about all of the time is intraday liquidity cycles. So, for example, if I make this very, very clear, right? And I don't know, maybe you've heard of this before. So this basically, as we know, like the markets work in cycles all the time. You have daily cycles, weekly cycles, but you also have intraday cycles. Okay. And the expectation with an intraday cycle means when you're positioning on a smaller time frame like ourselves on an intraday basis, you need to understand the context of what has happened from previous data in order to predict what to expect for future sessions and future price data. So what I mean by that is, example, Asia session. I want to ask you, what did this Asia session do? Did it go up, down, or sideways? If I just, without having like an objective framework or a mechanical way to work it out, what do you think happened here in Asia? Did it go down? Did it go up? Or did it go sideways? From this point to this point. What did it do? Distributed, right? I can see there's a lot of people saying that in the Google meeting, right? A lot of the exclusive community, it distributed, right? Meaning that we have gone from, okay, we opened and we started here. So this is where we began. Where did we end? Down here. Okay, this is a clear distribution in price, meaning lower, but not just lower. This is impulsive. So this is impulsive and this is a distribution. So when you're looking at intraday liquidity cycles, you first need to identify, what did Asia do? Before you do anything, what did Asia do? Okay, Asia distributed. Well, if Asia distributes, we can then expect London to accumulate. meaning that we can expect London to engineer liquidity. So that is the exact term for this. If you're sell biased, the exact terminology is engineer buy side liquidity. That's what we need to happen. So if Asia distributes lower and we are sell bias, we need London to engineer buy side liquidity. Okay, that is exactly what it did. Asia distributed. London sideways, engineering liquidity. Right? Not, yes, we have sell side liquidity below London low for sure. We know that. But when you're sell bias, we don't really care about that. It's where is the buy side resting? Okay. So the expectation is, okay, London accumulates. London engineers the buy side liquidity so that the distribution phase again can occur in New York. Right? So you have the London engineering. You then have further inducement, one above London high. This is like the first inducement. Breakout traders, traders from London, they're going to have stop losses above here. And so this is like the first initial inducement. Then once you've seen this, the expectation is New York will manipulate and then distribute in price. And there's two different models to this, right? This is like model or framework number 2, which is not really the textbook model. The textbook model is Asia accumulates and Asia engineers liquidity. And so this is like framework 2, which is Asia distribution, London engineering liquidity, inducement, second inducement. And then once you've seen that above fresh liquidity, you can then expect the New York distribution to take place. Why? Because we've reset. Because we've had a distribution. So we need a reset. Okay, this is the reset. Imagine just clicking like a reset button. Okay, we've seen the reset. And you can only get another distribution if you've seen that reset and then you see a fresh liquidation. It's very rare that you're going to see a distribution, then another distribution. Very rare. Extremely rare. And this is what I call intraday liquidity cycles. Took me 5 years to work this out, which is probably longer than most people. But I think when you watch the market every single day, you start to see these patterns repeating over and over and over again. And does it mean that this has to happen every day? No, of course not. But in general, this is what happens. Just like in general, we know we have a 50% chance of this playing out. We know that this is what happens on an average basis. Okay. So the other example would be, let's say your sell bias, Asia accumulates. If Asia accumulates, we can expect London to manipulate. Then we can expect London to confirm. We can position short here, invalidation above liquidity sweep, right? And then we expect the New York session to distribute. So we always expect New York to distribute. But the difference is if Asia accumulates, then you expect London to manipulate because the engineering of liquidity has taken place. Then we know we can get positioned with a clear invalidation in London. Maybe if you're late to the party, you can position in New York and then look at targeting lower via the distribution. So this is framework number 1. This is like the base case. This is the base case right here. You see this more often. But it's important that you're prepared for both frameworks, right? Not just one, both. And so that's intraday liquidity cycles in a nutshell. What session indicator do I use? Just ask in the free community. It's called Sonar Labs Sessions. Yeah, I've covered it thousands of times. So we have PMI today, but it's not restricted. So this is a very good point, right? We have PMI. So if I just pull up my economic calendar here on my other monitor, and we take a look here. Yeah, so we have PMI in 20 minutes. Okay. Is this a red folder USD news event? Yes, it is. Right? PMI is a red folder USD news event. Red folder USD affects the dollar. Okay. Is it restricted though? No, it's not. So if it's not restricted, then I don't care about it. It doesn't mean that, we're just going to tank lower. It doesn't mean that it's not going to bring volatility. But when I'm already positioned and I know that we have a red folder which is not restricted like PMI, I'm in the trade. I've accepted the risk. I understand that it is what it is. That's the kind of mentality. Like, I cannot control the outcome. What I'm not going to do, which is a very common thing, is you're going to micromanage, you're going to maybe try close it early and then PMI comes out or some other news and you're in and out. You're flip-flopping, you're back and forth, right? So accept it. It is what it is, right? And fair enough, if you have NFP or NFP, CPI or FOMC, then you can micromanage. But if it's red folder and not restricted, don't care about it. I welcome the volatility. So this is how you look. There's two ways to look at it. Number one is if you're already positioned, right? Which is us today, right? We're already positioned. Number two is what if you're not positioned and you have the likes of NFP or PMI? Well, if I just correct what I said, if we have PMI, let's just say PMI not restricted, right? Well, the expectation is as follows, right? The expectation is that, and this is if you're not positioned, expectation is PMI will create the manipulation. Let's just put it like that, right? So if you are already not positioned and you're thinking, well, how could I get positioned today? Or like, where is the volume or where is the volatility going to come from? There's really two places that it can come from. Number one, NYSE Open, 9:30 a.m. Eastern. This is number one. This is like your bread and butter. So if you're not in a trade and you're thinking, when could the volatility come in? Number one, boom. NYSE Open. If you're not in a trade and you're wondering, where else can it come from? Red folder. So it's important, we're not looking at predicting the news or the future or anything like that. All that we're doing is piecing together fundamental events in order to build a story to work out when can you expect manipulation. That's it. We're not, and 8 years ago when I started, it was, we have NFP today. I'm going to try work out what is going to be the outcome of NFP. You don't need to do that, but you do need to be mindful of news events. So remember, we're not trying to predict. We're not in predictive markets. we are trying to be reactive based on what we have seen. Don't predict. Leave that to the idiots, right? Leave that to the idiots. Idiots try to predict markets. Professionals try to react to markets, right? Leave the crystal ball shit to the idiots, right? The losing traders. Whereas professionals, we react based on what we have seen to build the story and the narrative of what you think is going to play out. That's the difference. So yeah, this is the two ways that you can expect manipulation. And in general, this is where it comes from. Because what happens at 9:30? Well, NYSE Open. What does that mean? New York Stock Exchange Open. But what does that mean? Well, that means that somebody that has an order from yesterday, their order's getting filled. Like imagine like you put an order in yesterday and well, the market's closed. You know, let's say you just want to buy the stock market, US 500, like a passive index fund or whatever, right? Well, your order's not going to be filled until 9:30. Just like in London, it's not going to be filled till 8 a.m., London Open, right? So that is why we get volume, because people can trade. You know, the futures market opens, orders from the previous day flood into the market right now, which is what's happening, right? We're on the open. Expect volume. As we know, a lot of the time, we get volume on the open. Does that mean it has to go lower? No. Just because we've seen a liquidation. But what it does mean is that it's more likely to trade lower. Because you're pairing your plan, your liquidation, with volume, with intraday. I mean, really the word is intraday volatility. If anybody wants to get very technical, which I know some of you guys are very specific, right? Well, what you want to study is something called intraday seasonality. If anybody is wanting to get very technical, intraday seasonality means when you look at the volatility across the day, when do you expect volatility to increase? Because that's when you're going to have the highest chance of success. Because if it ranges outside of certain windows of price, well, you're more likely to get chopped up. You're more likely to have a losing position because of the lack of volume. So that's really what it's coming down to. And that's why we trade the sessions that we trade. Because based on intraday seasonality, we expect volume in volatility. So, you know, looking at the market right now, you can see we have these sort of internal highs here. So if you drop down to like the small time frame, you know there's going to be buy side resting above here. So, you know, again, we're not trying to predict the markets, but what you could expect is maybe price liquidates these minor swing highs on the 1 minute. That's providing the liquidity on the open to be able to dump this lower. I see this a lot of the time. Like you have the open, it spikes above these sort of very small highs, which again, we're looking at intraday market cycles. But if you drop even lower, you also have like 1 minute, 5 minute cycles. And that's what this is. You know, do we pay attention to that? Not really. But I think it's cool to be aware of it and what's going on, you know, deep down on that sort of granular level. So if I just remove a lot of this fluff here, we have a lot of stuff on the chart. So yeah, that is kind of the thought process, is like, when you're heading into an open, if you don't have anything above you, like if you don't have any buy side that could be used, you could then become the liquidity, right? But I'm arguing here that we have buy side above these internal highs on a small time frame, which could be used as fuel again for institutions to position their orders to get filled and to drop price lower. Right? That's the what I'm arguing here. Because you're asking yourself, okay, we have the NYSE open. Traders may now think this is going to go lower. So how can they be induced on that small time frame? So it's like taking that zoomed out approach, which is like the intraday liquidity cycles, and then zooming in even more to work out, okay, I am positioned, but where again is the liquidity resting? Where again can people be induced into this market? Right? Where is the fuel resting? That institutions can use to position to prevent slippage, to get short, trap people on the wrong side and then roll it over. Or you can take the approach of, I do not care, and which is actually a pretty good approach. Like, you're in this trade now. So do you need to care about all of this stuff? Not really. But I think it's important to still understand what is going on. But yeah, do you need to really like stress about it? No, not at all, right? Of course not. Of course not, right? Will January be a negative month? I mean, again, you're trying to be very predictive there. Because if we look at the previous years of data, historically, December is normally not the greatest month. But December this year has been very, very good. So you can look at the data, and again, you're sort of building assumptions around it, right? But I still think you're looking at that from like a predictive mindset. Even if January, historically has been like a minus 2% month, let's just say. And that's off the top of my head, like it could be positive, right? To not trade it, in my eyes, is pretty crazy. Just like when people say, oh, I'm not going to trade in December because of X, Y, Z. It's like, well, show me the data, right? And even if you have the data, how do you know that that's going to be the outcome? Because at the end of the day, we are dealing with random distributions, which, to put that very simply, just means that you do not know when the distributions of wins or losses is going to come. You don't know the order. You don't know the sequence. You don't know when, why, or what is the reason behind it. And that is a random distribution. So often when people fail in trading, they may think that it's themselves or the strategy or, maybe they've had 5 losses and they think there's a problem. Well, what if the problem is just due to a random distribution? Meaning that what you have gone through is normal based on the distribution of your win rate and your returns. What if it's normal? And 99% of the time it is. So you always want to be asking yourself, like, is this normal? And when I say, is that normal? Well, you need, what is normal? That's the first thing. What is normal? And the only way to work out normal is data. Because then you have a benchmark to compare what is going on in reality to historic data. That's the only way you can work out if what you're seeing is quote unquote, quote normal, which again, I don't really like comparing things, but looking at it objectively, that is the only way in a trading sense. Okay, so then if you know that this is normal, let's say, what is the metric that you work out whether something is normal? Like how is your drawdown normal? Or what is a normal drawdown, right? And the only way you can do this is by backtesting. What is a normal drawdown? Well, I know based on my data confidently that a normal drawdown for me, based on historic data, with 1% risk, is around 7%. Okay, so I know based on my data that I can expect a normal quote unquote drawdown of 7% historically. Okay, so I know that. I know what's normal in my realm of what I can control. Right? Remember, these are just things that we can control. So I know what normal is. That's cool. So then when you see a 10, 11, 12, maybe let's say like a 15% drawdown, and let's take like a standard deviation outside of normal. So, let's take a standard deviation either side to be conservative, right? This is something that I did at university, right? You look at, okay, what is the average? And let's look at standard deviations outside of the average. Because, yes, historically the drawdown is 7%. Maximum drawdown, right? We're talking on across a year, like what is the max drawdown you can expect historically based on the system's performance, right? So, let's take a standard deviation. Let's say for argument's sake, this is like 10%. So you're going to say, okay, anything more than 10% is outside of normal. And so you want to be paying pretty close attention to that. Right? You want to be paying bloody close attention. If you go like a standard or maybe 2 standard deviations above normal, average, it's maybe likely that something shifted. Right? So the lesson here is work out what is your maximum drawdown. What can you expect? Work out standard deviations either side so that you can work out what is normal based on random distributions, not based on what you feel or what you think or any of that, but based on the probabilities and random distributions based on your benchmark. What is normal? Define that. Then you can start to control things. Okay, so we've been tagged in here. We're starting to push into profit. Right? Does this mean anything to us? Not really. It's good. Like it's good to see that we've been tagged, and pretty much since being tagged, we've had a tiny drawdown. and price is starting to show intention. We're also starting to get breaks of market structure on the 15-minute time frame, right? Because you have a high, higher low, higher high right here. We've broke structure to the downside on the 15-minute time frame. We're not talking about now like a 1-minute time frame. Like a 15-minute order flow shift is a lot more significant than your sort of 1-minute garbage. And so this is sort of increasing the probability of this playing out because we've broke structure. We're now indicating bearish signatures in price on the 15-minute time frame. It's a good sign. So, the probability of this playing out is around 0.5. It's now around 0.6. Okay. So, of course, there's still a chance that you're going to lose this trade, right? And we always need to be open-minded. But it is nice to see that we are pushing into profit. And we are showing clear intention here from sellers. Was the first entry valid, the one before the New York liquidation? So you're talking about maybe in here. This is not valid. So based on my invalidation frameworks, shorting here is not valid. And that's why I needed to see fresh liquidity taken out. It's also not valid because you're going to be trading into NFP as well. So there's like many reasons to why you would not take that trade. Okay, so all right, so we've had PMI. So for anyone that doesn't know, we had PMI like 1 minute ago, right? At 9:45 a.m. Eastern. Okay. And so what we have seen from PMI is it's this sort of candle here, right? So we had the closure and we started to see intention from sellers. Okay. Does this mean that it has to continue? No, right? But the first reaction from PMI was decent. And that's why I love the kind of set and forget framework. And I know it's very cliche and I know it gets a lot of stick in the industry, right? For sure. And for good reasons as well. Like if you don't have it backed up by data, again, you're pissing in the wind. You're spinning your wheels, right? But yeah, a lot of this stuff is just like, you don't even really care. Like there's going to be experienced members in here. I can see like a lot of like, one-on-one students and people that have been here for like at least 8 months in the community, which is insane, right? And you're probably listening to me right now like, Liam, just be quiet. Like, we're in the trade. It is what it is. And we know, like, just let it play out. We know that we cannot control the market from here, right? This live is being recorded. So like this has been an insane live so far. It is being recorded, so it should go up to YouTube, I would have thought. Unless I gatekeep it, which, I could do. Maybe I can put it behind a paywall. No, it'll probably go on YouTube. Yeah, we can hold with FTMO, sure. The only thing that you can't hold with is like if you had a trade through NFP today. Everything else is not restricted, so it's okay. All right, I think I've answered most of them questions. It's been crazy, roller coaster. What's been crazy? What's been a roller coaster? We got a question here from David. This is an amazing question, by the way, which is, let's say you have a sell bias market and you have a confirmation and you're waiting for, the next candle to break the low of the confirmation. So if I sort of spell this out, right, if I spell this out right here, like let's say this is your bearish confirm, right? Let's say this is your bearish confirm. And let's say that you're waiting for, the next candle opens here. You're waiting for price to break this low. You're going to enter via a sell stop or market execution on the break, right? Invalidation above liquidity sweep, right? And your question is, what happens if the next candle doesn't break the low? Your question is, what do we do in that scenario? Which happens, right? It happens quite a bit. And one of these things, which is what I talk about all of the time in the exclusive community, by the way, right, is something called candle theory, right? And this is a mechanical way to understand what you should do in that scenario. So for example, if the next candle, let's say that this is the high, this is the low, and like, let's say it closes something like this, like it's a pathetic candle. It doesn't break the low. Right? Well, that's an awful candle, by the way, but this is what we call, and this is what we classify as a inside bar, meaning it did not break the high, it did not break the low of your confirmation. Okay? And I can't go into like every specific regarding this. But what I will do is point you in the right direction, okay? So if this second candle, which is an inside bar, right, you need to work out what do you do if this is bearish and what do you do if this is bullish. So when you're building a framework, you need to know, right, under this scenario, right, and this comes into like filtering A+ trades, right, under these circumstances, what do you do if your inside bar is bullish or your inside bar is bearish? And you need a framework for that. And this comes into your entry model, right? One thing that I will tell you, which I can't tell you and disclose, so for everybody that is here, this is really important. If you get a bearish confirmation right here, and this is very public knowledge, right? If you get a bearish confirm and the next candle breaks the high of your confirmation, you cancel your sell stop. And you then wait for another confirmation. Okay. Again, these are more mechanical frameworks on filtering momentum. So if you're sell biased and if you get a bearish confirm, and if the next candle breaks the high before it breaks the low, you cancel. It's very public knowledge, right? According about what I sort of teach with candle theory. You wait for another confirm. Okay? Because the most important thing to you is, what is the most recent data telling you? Meaning, in the last 15 minutes, what is the market telling you? So if you broke the high, well, that's showing a bullish signature in price. So if you're looking at shorting this market, you don't want to see that. You don't want to see buyers showing intention and breaking a confirm high before tagging short, right? So, it's really important. There's many different ways to kind of break this down. This is how I look at it. And it's using candle theory. This is the name for it. Okay. Great question. So we're kind of in a little bit of a drawdown here, right? We've had an excursion of around 50% towards the stop loss, okay? So my thought process here is, we have this high, we have these internal highs. So we've just took out the high of the NYSE Open, right? We've just took out the high of the New York Open, the first 15 minutes, 1.5, right? So we've took out the high, and so it's pretty much here where we need a decision. Either institutions use this buy side as like the final fuel to load this, or it's pretty much curtains. So this is like the decision point here. Either sellers step in here and they position the bigger players, or it's curtains in my eyes. I don't think there's any sort of in between, because this is where the buy side is on the very small time frame that they can use to prevent slippage to position. So either they do that or they give up and we get that. So for me, this is like the sort of penultimate area, the area of interest that is very important to us, that is developed after the open. Because again, as we know, a lot of the time we get that NYSE liquidity raid, take it out, right? Just like we take out like Asia and London buy side, there's also buy side above the open high and low. So if you take the first 15-minute candle and you plot the high and the low, you've got buy side above here and you've got sell side liquidity below here, right? So you have fuel above here, right? Remember how we talk about fuel? That the institutions can use. So maybe they do, right? But again, we're not trying to be predictive here. Because once we are tagged in, we're not trying to predict anything other than it's probably going to lose. That's what I like to do, right? Like when I get tagged in, I'm like, this is probably going to lose. And so anything other than a loss is like a positive outcome. Because if you lose, then you meet expectation. If you win, it's above your expectation. So you can't really be disappointed. Whereas if you go into a trade like, oh, this has to be a winner, well, 50% of the time you're going to be disappointed. For sure, because we know that based on the data. Yeah, let's see. What if the inside bar has broken the high if we go short according to candle theory? it depends on context. Like it depends if you're sell bias, buy bias, what the confirmation was, whether it was bullish or bearish, and the order that we break the confirmation high. Like, do we break it first? Do we break it after being tagged? Like, you know, need a bit more context, I'd say. Oh, roller coaster, right? Like, oh, as in like, yeah, normally it's just been flying to take profit, right? Like, your expectation of these streams must be so bloody high at this stage. Hence the turnout, right? But because every trade that we've sort of seemed to have taken recently is just bloody flew to take profit. So yeah, I get it for sure. Like when it's not flying, which is often the reality, right? You start to build up like, oh, is there something wrong? And it's like, no, like this is normal trading. Most of the time, it's not just going to fly to take profit. Some of the time it will, right? Which seems to have been recently on these streams. Yeah, hence the win rate, right? Hence, like, you know, winning 9 out of 10 trades in a row on ES, US 500, right? Yeah, I mean, that's not a bad assumption. Like, you know, a lot of this news is going to be like getting digested into the market. But again, it's like, how do you make that mechanical? That is like very subjective stuff. Like if you know, how do you define that? How do you define digesting a news event? It's very hard. I mean, I'm sure there's some very fancy algorithm that does something like that. But yeah, here's the sticking point, guys. Either we roll over here and we start getting that pressure, or I believe that it's probably curtains. Some may say that that's quite cynical because we could just technically sort of range and chop lower. Like that's an outcome as well. Like people forget that's an outcome. They assume that it has to be lower very fast, stop loss very fast, and they forget that it could just chop lower. Like you just have the bias, right? Sometimes when prices moved very impulsively, you need that sort of correction because as we know, right, price impulsively moves. Then we get a correction. After we've had enough correction, we then get another impulse. So my thought process is, okay, we've seen the impulse, which is the confirmation here. Are we in the correction phase, which is right here? And so if we've seen the correction, which is what I'm saying, like either the correction's over here or we're done. And if it's over, then we expect distribution again, i.e. lower prices. And I know that's messy as hell, but you should get the point. Yeah, I think I should be like an artist or something. Like Picasso needs to chill out. You know, me and Picasso are best friends. Is Picasso even alive? Like, I don't even bloody know. I should know this. I'm assuming not. I don't think so. But we were best friends. Have I backtested NQ with this? NASDAQ? Yes, I have. ES performs better. US 500 performs better. So that's what I trade. Okay, so finally, this trade is hit take profit. So I'm pretty tired, I'm pretty ill right now, but this trade's finally smashed take profit, free 1 to 2, free mechanical repeatable 1 to 2. So as we know, we executed in here, and then it was just a case of allowing this trade to play out, right? Set your stop loss, set your take profit, allow it, don't touch it. I'm going to place a screenshot right now of everybody that took this trade. So, this was taken live in front of hundreds and hundreds of people. So thank you for being part of the live streams. And this was a banger NFP trade. Absolutely sensational. What did we have? Well, sell bias market, buy side liquidity, which was engineered in Asia. This was taken out from NFP. Institutions used this buy side liquidity to position into the market. The market showed its hand via this 15-minute bearish confirmation, and this was during a New York kill zone. What we got was some volatility around the NYSE open, 9:30 a.m. Eastern. Volatility. These intermediate highs were used for further fuel, for institutions to short against this. So what we actually got was a very small time frame liquidation of this buy side liquidity generated from the open and these intermediate highs. Institutions use this to, again, further position into the market. This is what provides the fuel, right? Because this retail buy side, institutions can position their sell orders because there's equal and opposite orders to fill. And then it's just a case of allowing this trade to play out. Again, we took out the London low. Buyers tried to step in. This is another inducement. So traders are going to see this as like a double bottom. Stop loss below here, further providing sell side liquidity that the institutions can use. So they're getting long, induced long, again, retail or long. Institutions can use this to sell against in order to keep pushing price lower and lower and lower. And we hit our final repeatable mechanical take profit below external range liquidity, below this low right here. This was the low of the day. And so we expect this to be taken out. And that's exactly what happened right here. So beautiful trade, valid A+ trade. I would take this every single day if it did present. Sensational. So I hope you guys learned something from the stream. Have a great day. Take care. Bye-bye.